Please note that the information on Retire Vivid referenced in this video is accurate as of November 1st, 2024. Changes to laws and regulations may make portions of this segment outdated and no longer relevant. Information presented is for educational purposes only and is not intended to provide investment, tax, or legal advice. Please see our full disclosure at the end of this video.
Welcome to Retire Vivid. I'm Karen McCarty. That's Tommy Breitbach. And today's episode is on IRAs. We're going to talk traditional IRAs, Roth IRAs, 401ks. I mean, most people's wealth is inside of these accounts. I mean, if you take a look, there was a study or a survey that was done through the Investment Company Institute. There is over $13.6 trillion, with a T, trillion dollars that is inside of these assets. I mean, that's a lot of money.
Yeah, as of year-end 2023, I mean, you're looking at a little over a third of all kind of retirement assets bundled within these types of accounts. So it's, hopefully we're looking to make some smart decisions with those. Well,
I mean, we always talk about it. It's one of the largest assets people have outside of their home. And so, when you're working, you're contributing to these plans. I mean, we've done a tax episode when it comes down to, Roth versus traditional, but I want to talk about common mistakes, things that we tend to see, especially as people come through our doors.
Right, and the Investment Company Institute also shows the amount of individuals owning IRAs, compared to the employer-sponsored plan. So as you're working, you're probably contributing to that 401k, 403b, TSP, whatever that is.
Right.
And as you get older, you tend to see more incidents of IRA ownership.
Right.
And so as we're looking to use those for retirement, we want to be smart with it
right.
and make some good decisions.
Absolutely. So we got a lot of good things we want to talk about. So during this first part, what I want to do, let's dial into the traditional IRA, and then after that we'll move into the Roth and then the 401k. So let's get started. The first one is waiting until the 11th hour. Let's talk a little bit about that.
So most people funding your employer-sponsored plan, you're doing payroll contributions. It comes out throughout the year.
Right.
With IRAs, you have up until your tax filing deadline to make a contribution for the prior year. But that's not always the best option because you're looking at the S&P, around 70% of the time, going back through history, the S&P is positive. You go back to 1980, the S&P has hit its high in December, just over 50% of the time. And so if you wait until the following, March, April to make that contribution, you've missed out on, potential gains, and those gains can add up over time.
Well, and then we in the past we did talk about different investors in terms of when they may enter the market, and so then that's important because what do we want people to do? We want you to feed and fuel those retirement accounts because again, a lot of our clients are retired, and so their job is to feed, and then their money's job is to grow, right? And so the question is which one do you do? Now, there's also different things too in terms of contributions. You already talked about that, and also Roth conversions, right? Different timeline instead of a tax deadline.
Conversions are calendar year. So to convert from an IRA to a Roth, it has to happen between January 1st and December 31st. Compared to the contributions we just talked about up until the tax filing deadline.
Absolutely. So that's a good one. Okay, let's talk about the next one. Spousal contributions. I think that a lot of times is, let's just say we have one spouse that's working and maybe another spouse is at home taking care of the kids, the toughest job of all. But they think, oh, well, I can't contribute because I don't have any earned income. That's not true.
It is not true. It's, as long as there are wages or earned income to support contributions for both, your IRAs and your Roths, you have an annual contribution limit, but as long as there's wages or income greater than that, you can make both contributions.
That's right.
Or a contribution for each spouse.
Absolutely. So if one spouse has that income, the other one doesn't, to your point, that other spouse that does not have that earned income can make those contributions. So we do see that one a lot. We actually do. I also want to talk about asset location. That one of the benefits with a traditional IRA is you receive tax deferral. unlike a brokerage account where if you do some trading, it could potentially generate capital gains.
Spend some time on this, but your non-qualified accounts, so if it's an individual joint trust, those type of accounts that have taxes based on the transactions in there. So you get taxed annually on dividends or interest or realized gains from sales. So if you're looking at a little bit more of an active strategy or a high interest income type product, you can take advantage of the tax deferral within the IRAs.
And that's a benefit, especially when you're actively trading, like you mentioned. So let's talk about rollovers as well, too. I mean, it's, specifically the 60-day rollover. Beware. Address that one.
Yeah, the 60-day rollover allows you one time in a 12-month period to take money out of your IRA and put that back within that 60-day window without incurring tax penalties. But again, it's one time and it's 60 days. So if you're looking at that and you're not able to get the money back in 60 days, or you have a couple different IRAs out there, you've taken one from 2 different IRAs, you get one across all IRAs in a 12-month window, 60-day period.
So again, we're talking about what if you did 2? You can only do 1.
It becomes taxable.
It becomes taxable. And that's also where if people are going to roll money out of their 401k plan, just do institution to institution. Don't have the check made payable to you. Make the check payable to the institution, right?
And then it falls under a direct rollover.
A direct
and
rollover.
not the 60-day rollover process.
That's right. That's right. Well, let's also talk about RMDs. And so, this is required minimum distributions, right? So, for a lot of folks, when you attain age 73, the government says, hey, it's time to start paying tax on these accounts because you've got tax deferral all these years, but now it's time to start paying tax. I want to talk about pre-planning with it because, again, we can call this potentially a tax bomb later in your retirement years.
Right, and it's something that's going to happen. You are going to hit an RMD age. And that money you've taken a tax deduction on, it's grown, you are going to have to take a percent out. That percent grows every year. And so it can be, pretty sizable required minimum distribution you need. Mm-hmm. So for an individual that, has an income need at 4%, you get into your 80s, that RMD can be up to 6%. So you're going to end up taking, possibly more than you need.
And the big question people come to us with is, hey, what do I do with this money? Well, you could gift it, which we'll talk about here in a second. You can put it in the bank or reinvest it, but I just say gifting. Let's talk about a QCD. What does that mean?
A QCD, yeah, that is a qualified charitable distribution. The distribution goes directly from your IRA to the charitable entity, a 501c3 organization. And that money provides, it can be more tax efficient than taking a distribution, gifting cash or a check to that institution. It can be more beneficial from a tax perspective.
We just talked about the tip of this iceberg here. We got a lot more to go through. So next we're going to talk more about the Roth IRA and some common mistakes that we see there. Stay with us next after the break.
Retirement planning can come with more questions than answers. How do I save money and taxes during retirement? When should I file for Social Security? And how do I retire my 401k? With so much to plan for, how do you know if you're making the right decisions? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to help get you retirement ready. Schedule your 15-minute retirement review today.
Okay, so we're talking about common IRA mistakes that we tend to see with clients. We just talked about the traditional IRAs. We're now going to move on to Roth IRAs, and this is actually a good one to talk about because assuming that the Roth is always best when it comes to making contributions. That's not true all the time.
That is not always the case, and it's usually determined based on current tax bracket and where you may be or will be in retirement.
Right.
Sometimes that's not easily defined, and so, if you're in your lower tax brackets, Roth is probably better. The middle tax brackets may be uncertain, And the higher tax brackets, if you know it's going to be lower in retirement than traditional or pre-tax contributions.
Right.
So one way to go around that, if you're in the middle and not sure if you're going to be in the lower or middle brackets in retirement, you can split those contributions.
Right, split them up.
Yeah,
Right.
do a little bit of each and
Sure.
give you some flexibility down the road.
Right. Right. And if you're in the higher tier, like you said, I mean, yeah, well, it really comes down to, where are you going to be when you do retire, right? Because we have that earned income coming in, or W-2 income. It may make sense, like you said, to do more contributions to the traditional, get that tax deduction, convert later. I mean, I don't know people's tax situation. I mean that's the whole point of this show is to do a blanket across the board. But I also want to talk about a backdoor Roth. I mean, there is a pro rata. I mean, I want to address this one because this is something that's also that people may utilize.
So for those who have heard of the backdoor Roth, to be able to make contributions directly to a Roth, you have to be income eligible. There's a range of incomes where your amount of Roth contributions are capped out. And so if you're looking at a backdoor Roth, same income levels apply to the deductibility of pre-tax IRAs. But a backdoor Roth is making a non-deductible contribution to an IRA.
A non-deductible?
Non-deductible because your income is too high,
Yep.
and then converting it to a Roth.
And converting.
So one thing to be aware
There's some caveats.
of.
though.
One thing to be aware
Yeah.
of. There is a pro rata rule.
That's right.
So if you have employer-sponsored plans out there, 401ks, 403bs, does not apply. But if you do have an IRA at one place, you open a second IRA to make that non-deductible contribution and then convert it, you are going to get prorated across those balances. So there may be some of that is taxable when you do a Roth conversion.
That's a great point. So again, folks, just beware of that. There's a lot of cool things that you can do. The question is, does it make sense for you? So make sure you seek a professional, specifically a tax professional. Okay, let's talk about delaying the IRA in the Roth. I mean, in terms of a planning perspective.
If you have money, you're thinking, I may not have that right now to be able to use 30 years from now. The one thing with Roth IRAs is that you can always take your contributions back out tax-free.
Right.
You didn't get a tax deduction going in, you can take those out tax-free.
Right.
It's not ideal, but you are, if there are some short-term considerations or you're looking at not having enough saved, you would be able to access the Roth contributions.
Right, it's FIFO. The first in is also the first out, right? So yeah, now the big one. This is the big one. We talked about this last episode, and it's the 5-year rule. What in the world is the 5-year rule? Because you were really hitting the nail on the head there. A lot of people say, oh yeah, I'm gonna put money into a Roth. Boom, it's tax-free from day one. Hold on, let's pump the brakes. That's not how it works. So there's actually 2 5-year rules. Let's talk about that.
The first 5-year rule is just the age of the Roth IRA. So it begins, it's counted to January 1st of the year you make your first contribution or conversion. Earlier we talked about waiting until the tax filing deadline. So you make a contribution in March for the prior year, your 5-year anniversary started at the beginning of the prior tax year.
Now you said a IRA, Roth IRA. We're not talking about the Roth 401ks, right? So the first 5-year rule is, have you started a Roth, right? And so if there's a tip for people out there, if it makes sense for them, is to do what? Start a birthday.
Just get one going, and there's
$100, doesn't matter.
There's no income, there's no dollar amount requirement.
Right.
It's just to have that Roth IRA open and funded with a little bit of money.
It doesn't matter how much, as long as you start a birthday for the first 5-year rule. Now let's talk about this one. Let's just say that we did do a Roth conversion. Let's talk about this. If you did a Roth conversion prior to age 59 and a half, okay? So the question I would have is, okay, did you accomplish the first 5-year rule of starting a birthday? Otherwise, there's a 5-year rule there.
On each individual Roth conversion.
That you did.
On each Roth conversion that you did under 59 and a half.
Right.
So if we're sitting here looking at using these for retirement, most people are probably looking at using them past 59 and a half. So look at starting the Roth IRA anniversary date.
Start a birthday. I mean, that's the takeaway. Start a birthday. Okay, well, I just talked about doing a Roth conversion prior to age 59 and a half. Let's say you did this, Tommy. Let's just say you did a Roth conversion of $50,000. I'm just using a number. And of the $50,000, let's just say $10,000 of that went to taxes.
Under 59 and a half, the amount of money that does not make it to the Roth IRA is considered an early distribution. So it is the full Roth conversion amount is taxable, and then you're looking at an additional 10% tax penalty on the amount that didn't make it to the Roth.
Which would be the amount that went to the IRS, for example, for
Amount
taxes.
withheld for taxes, yep.
Right. And now, again, I mean, depending on the state of who our viewers are listening to, but here in the state of Iowa, again, if you're over 55, you wouldn't pay any tax on that for state tax.
At the state tax.
At the state tax level for Iowans that are 55 and older. So beware of that. I mean, that's something that a lot of people don't realize. They go, wait a minute, I thought, nope, you sent that money to, it's classified as a distribution. It is what it is. How about this one? Let's say you did a Roth conversion and you go, oops, I did too much. Can you reverse it?
Too much being you bumped into a new tax bracket, or
Good point. Yeah.
or you're, on Medicare and you're looking at the income related amounts.
IRMA.
You get IRMA.
Yeah.
It makes Medicare more expensive. You do too much, you can no longer do what's called a recharacterization.
Right.
So you can't say oops.
You can't say oops?
You can't. Well, you can say oops, but you can't do much about
You
it.
can't do That's good. Well, it's not good. So folks, I mean, we're laughing about it, but beware of this. I mean, in the past, you could redo it, you could refix it. Can't do that anymore. I mean, so when it's irrevocable is what we're trying to say. So if you're considering a Roth conversion, I just said earlier, speak to a professional. Speak to a professional. I mean, that's also what, Tommy, that's also why we're doing this show. I mean, and one of the things that I think people have found very informative, if you would, is our 15-minute retirement review. This is where people have the opportunity to give us a call. They can ask us these questions, whether it's on taxes, Roth IRAs, traditional IRAs, your 401k, or just retirement in general. I mean, I think people have found a lot of value out of this call.
In this show, we address broad topics.
Right.
And everyone's situation is unique. You may have something going on that doesn't exactly apply to what we talk about. And so you have those type of questions, we can probably answer them.
I mean, we are going through a lot today, but guess what? Wait, there's more. We have more to go through. So we just talked about traditional IRAs. We talked about Roth IRAs. I want to touch on the 401ks, 403bs, 457s, you name it. Make sure you stay with us. We got a lot more after the break. Okay, we're wrapping up common IRA mistakes. And so before we get into the IRA or the 401ks, 403bs, 457 plans, whatever line of work you're in, I want to address one more thing. And this is what we call bracket bumping. And so our goal is, well, what our clients are looking for is, they don't mind paying taxes. They just don't want to pay any more than they have to. And so I want you to take a look at this example that we have for people that do pre-planning versus folks that may not. And so in this example, they got $2.5 million in terms of IRAs, 401k plans. And then they're both 65 years old, $230,000 of taxable income. But take a look at this, folks. This is really interesting to show you. Take a look at where they're at prior to the required minimum distribution age, in this case 73, and then boom, it just popped them into those higher tiers. By doing pre-planning, we can look at Roth conversions. I mean, Tommy, that's the things that we're looking for.
We did talk about pre-planning for those RMD. You have two options because they're going to happen. You can do nothing, let them happen when they do, or look at being tax efficient and planning early.
And so in this example, we're showing that. I mean, that's the whole goal, and the reason for this show too is to help people become more tax efficient, because we just said it. The people's wealth is inside of these plans, and the question is when do I pay tax?
It's a very real consideration, and just based on that dollar amount, there is going to be a lot of taxes paid.
Right.
So if we can be tax efficient with that, it may make some sense.
It's a win. It's a win-win. Now, I'm glad we talked about that. So let's keep moving. I want to talk about the 401k, 403bs, you name it, okay? And so let's just say somebody wants to retire early, all right? I want to talk about the rule of 55. Walk our viewers through that.
Early being prior to 59 and a half, because if we're talking about IRAs, you have taxes on those withdrawals, but withdrawals prior to 59 and a half, you have the additional 10% penalty. The rule of 55 allows individuals to access the employer-sponsored plan from the job they most recently left after age 55 without that 10% penalty. And it's flexible withdrawals, and then obviously the tax savings associated with that. But one consideration is to be aware of or think about the rule of 55 if you are looking at retiring early and rolling those assets to an IRA.
Yeah, be careful of that. I mean, and I hope they're not getting that advice where if they are going to live on that, from an advisor, I mean, it needs to stay in that plan. Otherwise, you're just hurting yourself because what you just said, there's a penalty that you got to deal with. Now, I don't want to get too deep into this. Actually, I really don't want to get into it at all. But the one thing is if you did roll your money out prior to age 59 and a half, there's what they call a 72T.
72T is a series of substantially equal periodic payments, but it's more restrictive. There's specific calculations.
Yeah.
It requires withdrawals for a 5-year period or until 59 and a half, whichever's later, and you can mess it up pretty easily.
That's why I just said I don't want to talk about it. I mean, I try to avoid it if we can. I mean, just take advantage of the rule 55. Okay, how about this one? Let's say that you're working and you have or maybe not. Let's say you have a 401k that's out there, and and you want to roll your money into a traditional IRA, but you are of required minimum distribution age. Let's talk about that.
Once you are still working and of RMD age, you want to review your plan documents for the still working exception. And that would allow you to defer those RMDs while you are still working for that employer. If there are other IRAs or prior 401ks, they will still have the required minimum distribution, but the plan that you are still working for may allow you to defer that RMD.
There's some people that work because they want to, not because they have to, or the other way around, but still, know your rules. The other thing, you cannot roll the RMD. Let's talk about that.
So if you have retired after RMD age or at RMD age, the first money out of that employer-sponsored plan account it needs to be the required minimum distribution. So if you just take a full lump sum rollover into an IRA, roll over the amount that was supposed to be the RMD, you fall into an excess contribution, and reverse it, there can be tax penalties.
There can be tax penalties. Folks, just some things you all just need to be made aware of. A couple other things I think to wrap up, beneficiary designations, that's important.
The beneficiary designation controls where the money in that account is going. So you can have this great estate plan drawn up, whether it's a will or trust. You say you want assets to go to one place. The beneficiary designation on the account is going to determine where that goes. So if that hasn't been updated or reviewed in a while, there may be somebody on there, or maybe somebody needs to be added, maybe somebody needs to be taken off. Just review those periodically.
Especially with the inherited IRA rules now, right? In terms of, depending on if you're a non-spouse or a spouse, but anyway, where a potential 10 years that money must be depleted or out of that account due to the Secure Act that was passed recently. So we'll talk more about that in another episode, but let's wrap up with another one. This is actually a good one, a minor or a custodial Roth IRA.
It's an account if you're looking at for parents with younger children or grandparents want to start grandkids off on the right direction. Minor Roth is a great option for them if they have earned income. So if they're working a job, they have that earned income that they can show. Parents, grandparents, aunts, uncles, friends, family are able to make a contribution into a minor Roth up to the amount they've shown for earned income.
Yeah, and that's the big one. You got to show earned income, and so. But the minor Roth is a great way. What a great way to get your family, your loved ones started, and when it comes to investing. And what are we a fan of? The Roth IRA, right?
Roth IRA.
Tommy, is it about as clear as mud now? I mean, we went through a lot of information today. I mean, we blew up the airwaves.
I felt like we got through a lot pretty quick.
Well, again, folks, I hope you learned something today. I mean, I know we went through a lot, but that's why we're doing the show. I mean, we're here to help you, guide you, give you the tools that you need, so that way you all can make an informed decision when it comes to your hard-earned money or your retirement overall. So we'll catch you next time right here on Retire Vivid. Thanks for listening.
This segment is brought to you by Vivid Tax and Wealth Advisors. Learn more at retirevivid.com and make retirement vivid. Cameron McCarty and Tommy Breitbach are investment advisor representatives of Vivid Wealth Management, a SEC-registered investment advisor located in Des Moines, Iowa. Investment advisory services are offered through Vivid Wealth Management, LLC. Insurance products and services are offered through Vivid Tax and Wealth Advisors, and individually licensed and appointed agents. Tax planning and preparation services are offered through Vivid Tax Center, LLC. The preceding entities are affiliated. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Case studies and examples presented are hypothetical and used to demonstrate a concept. These studies do not represent actual clients or results. Similar or even positive results cannot be guaranteed. None of the entities above are affiliated or endorsed by the Social Security Administration or any government agency. Information expressed does not take into account your specific situation or objectives and is not intended to provide investment, tax, or legal advice. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Investments involve risk and, unless otherwise stated, are not guaranteed.